Okay. Well, hello, everyone. My name is Stephen Morris. I'm pleased to be here and spend some time going over concepts relative to the office sector. My background has been that I've been a broker, more than I want to say, but certainly I started in the 80s representing landlords for about 20 years. And I segued about the year 2000 into only doing corporate tenant rep work. I've also had the honor for the last 15 years of teaching a class at the Ross School of Business, University of Michigan. It's an elective class where the students apply a lot of the metrics from corporate real estate to real estate finance, such as depreciation, time value of money. And we go over actual real estate concepts, and then we relate that to the finance part. So I'm going to take one of the classes, one of the slides from one of my classes on leases, just to segue in. A lot of this you may know, and there may be a few other areas that we can kind of review again. So we're going to just start number one on leases. We got base rent. So base rent basically is the rental rate. If it's an office building, then we're paying gross rent, base rent, and that would include the debt and the expenses. And we've got escalations in rent. Us office folks will see probably 50 cents a foot, or if we're down doing deals with Bedrock, it'll be 3% instead of 50 cents. But this is also more related to retail, where that retail tenant pays the base rent. They pay their bumps every year, and then they pay a percentage of volume. And the percentage of volume is figured out on a calculated formula so that the landlord can get back the funds that they work to bring the anchors in. The whole key of being in a mall is that traffic, and the anchors don't pay a lot, but they bring traffic in. So they have what's called overage rent. Overage is a certain number that's calculated on that rent composition. So also, those of us who are office brokers, most of us are doing gross leases where you've got the expenses and the rent included, the rent saying mortgage, profit, base rent, and then operating cost and taxes. So that's a gross rent. The tenant is paying one rate for those numbers, usually plus electric and escalations. Then there's triple net, which we could go on to. Next slide, please. So comprising the expenses that's included in the base rent or in a net rent, we have common area maintenance. Common area maintenance, again, we'll go back to retail. That's the center area where we all walk with our bags going from store to store. That area's got to be cleaned and ventilated and have security. It could be a strip center. Common area would be where the parking is, landscaping, walkway in. You don't hear about common area in an office building unless, again, it's triple net. Those doing industrial, again, industrial tenants, they pay just one number for the rent. They pay all their expenses, and then they pay the landlord's CAM or parking lot, maintenance, the security if needed. Tenant's specific space, rate related to a specific spot, in this example, in a shopping center. Reimbursements, landlord is funding expenses in a shopping center and tenants are reimbursing. We negotiate expense stops, which basically mean that limits the amount of expense obligation that a tenant has. In a shopping mall or industrial, might be provisions on the heating, ventilating, air conditioning, again, being a cost that the tenant in a retail center would absorb. You don't see this clause, HVAC provisions in an office building. But again, with that retail area, security is bigger than ever. And that maintenance, that hallway is cleaned and cleaned a lot more given COVID. Next slide. So tenant improvements, this is a big area. Tenant improvements, clearly those that are in the office building, part of owning an office building, it's a lot different. Those that own apartments, when a tenant moves out, you'll clean the carpeting, If there's nothing else wrong with it, the new tenant comes in, you didn't rebuild the space. But an office, it may have been a law firm, and the law firm has a lot of offices. Somebody's coming in and saying, no, we're tech. We don't want any walls at this point. We're going to have workstations. We're going to keep an open environment. Well, that's going to cost. So it's endemic in the office sector where you as a landlord, you're going to cover tenant improvements when the tenant's lease comes up for renewal. When a tenant's lease comes up for renewal now with the pandemic issues and social distancing, most of the landlords are going to be hearing what? Well, they're going to hear that we need less space. We're going to do hybrid. There'll be some hybrid probably. So maybe 10 to 30% of that space is taken back. Okay, so there's a cost for the landlord to get that set up. That'd be a cost for the new tenant. The financial responsibility I'll just go through the different sectors. In the office sector, landlord is going to cover a substantial allowance. What's that substantial allowance? Depends on the term of the lease. $25, $30 a foot. Those of you might find that to be normal. But with construction costs going up, as we've heard, with inflation costs for materials, labor going up, that 25 or 30 doesn't get one as far. You might see a build out requiring 40 to 50 for something that might have been $30 a foot a few years ago. So the landlord will put in part of it. Industrial side, those in industrial, there's very little money funded by the landlord, and it's similar in shopping centers at this point. For the most part, these retailers cover all of their costs inside the space. Completion responsibility, that's a legal issue, I guess, to get that done prior to, at a certain date, getting it done. I always tell people, those people that are doing any building in the fall, you better not, you better be concerned because you've got those holidays at the end of the year. What are those holidays? It's Thanksgiving, and there's Christmas, Hanukkah, there's New Year's, and there's another one. It's called hunting season. You can lose a month at the end of the year. So TI concession just means the landlord is going to come up with more funding and to get a tenant, in negotiation, landlords will come up with more cash, and endemic, you're going to see rental concession, meaning some free rent. And any smart landlord is going to say, okay, I'll give you the first 6 months free, but you got to extend that lease another 6 months so I can tell my lender I got a 60-month lease. In that regard, but that's a big issue. Next slide. Rental types. Okay, so we're kind of familiar with most of these. Net rent just means that start with industrial. The tenant's paying the base rent. That landlord comes up with a number to cover their mortgage and to cover their rate of return. And then the tenants pay all the costs. That's the best thing for a landlord to be involved in. Gross rent, we've mentioned. So that's including everything except electric usually. There's a base year. We'll talk about a base year if we have time to get to the lease auditing, where the landlord says, well, okay, this is what? This is 17th, 18th of August, and the tenant's going to sign the lease. I'm working with one right now. We're going to start the rent October 1st. Landlord's going to say your base year is 2021. So that means the landlord's paying for all the costs this year, 2021. Starting in 22, the landlord will still pay that base, but there'll be estimates for increases. The landlord may estimate based on inflation, 3% or whatever. The tenant will start getting a bill, 1/12 every month, for escalations in operating costs to operate the building, office building usually. And then there's a reconciliation a year later to see whether the landlord overcharged or the landlord undercharged to get that done. Effective rent is a formula. It's taken into account where we take the rate. The question is, what's my effective rent to get you? So I start with my gross rent, but then I had to come up with extra improvements. Going to have to take that out of my return. Then I come out with the free rent. That's a issue. Take that out of my rent. I wanted a tenant. I agreed that I would pay a moving allowance. Take that out, and then you do the math on those subtractions. So your rate might be 20, but your effective rate could be 1850. It's an easy time value of money, because you might want to say this is a 5-year time period, and over 5 years, I had to put out this amount of money up front. You come up with a percentage that you want to use today for a number to analyze and return 4 or 5%. That's your effective rate after concessions. It's a term that not everybody might heard of. Next slide, please. Non-economic terms, signage, that's important, either in a shopping center or on a building. When we drive by Northwestern Highway or Telegraph or I-75, there's always a sign on a building. And that usually only goes to a larger tenant, at least a floor or more, or the largest tenant in the building. They can benefit from that. That has value. Going dark is a number that we hear about in shopping centers, which means that a tenant is closing up at that point, and that can hurt the other tenants in the building. Hours and days of operation, that really is a retail number. There's got to be policies made, because retails feed off of each other. You got a women's wear store, the shoe store next door. People go get some shoes to match the clothes. So they really require, in a strip center, in a mall, to have those hours regulated. Otherwise, it's not something you see in office or industrial. Length of lease, well, the longer the lease, landlords are going to want to get a longer lease because they are able to amortize improvements. They are able to, when they decide it's time to refinance, the lender looks at how long the term of lease is. So there's a lot of value to longer the lease for the landlord. On the tenant side, they're going to lose some flexibility in these times. They may want to be 3 to 5 years. Things are a little better now, a little more certainty, so they may go to 5. So it's best to always, look out. Obviously, brokers enjoy a longer lease, but it's best to look out for the needs of the tenant. It'll come back for it. It'll come back to you in spades that we looked out for their needs first. So today we're seeing terms of closer to 5 years, in some cases even a lot of 3-year renewals with the uncertainty. Expansion rights is always in a good lease and an office lease, giving the tenant the option to expand or first right of refusal. But I also tell people, well, that's important. We want that in the lease, but we want a contraction clause. We want to be able to give back some space without having to go out and sublease. We want to put it in the lease. So let's make a decision that we're 10,000 feet. We're fine, 5 to 7 year lease. We'd like to contract, give you notice for that, give you 60 days notice. Allow us to contract, 20% of your space. And it gives you some protection for your clients. Next clause. Non-economic terms, okay, usage restrictions. Well, that relies on the zoning at that point. What are you allowed to put into your spot, whether, depending on what type of use at this point. The location assignment, well, that might be in the building at this point. If it's retail, there's certain spots, there's corners that are important. In a strip center, there's an end cap. End cap is strictly the end of a building. So you got visibility on several different sides. So that helps a lot. Space description is what a space planner would come in and do at that point. Description isn't the best comment. Space design would probably be better. Office building landlords will pay for designing to help you come in. Retail, you're on your own. Industrial, you're kind of on your own. And tenant mix is clearly retail. Again, strip center, go back to it, put all the things that work out fine. You got a grocery store to bring people in, a CVS to bring people in. And then if it's got some fashion aspects to it, then you want to put a mix, like I mentioned earlier, women's wear, jewelry, shoes, baggage, at that point. Parking in office buildings, obviously parking is important with the ratio. There's different ratios in different cities that would allow, I think in Troy and Southfield, it's 5 per 1,000. Obviously we've got less people driving to work now. And then the other part is, people love covered parking if they can do it. So recourse means that you are guaranteeing the lease at this point. I've never had a tenant agree. I've always fought hard that we don't want a tenant to personally guarantee a lease. Law firms will sign up just as the firm or a shell corporation. Security deposits are less common today, more negotiable on the tenant side. I don't like when I'm on a renewal negotiation, I always try to get that security deposit back. I say the tenant's been here for 5 years, you have no issues involved. You shouldn't be holding your money at this point. So it's a negotiable item. Let's keep going. Now, lease abstract, real important to do. We'll go over some more terms at this point. This is what I do when I'm working to get an assignment. This is actually an actual one that I've disguised this particular lease. And I not only went through and did a summary of their lease, but I made comments on it. So a lease abstract is something good if you're trying to get a tenant to hire you, analyze their space, or maybe when you haven't renewed the space for a while, it's time to take a look on what you agreed to. So we've got the size down. I went through and analyzed the fact that there was 25,000 rentable, and they added on a 10% load factor, which is actually less than most office buildings today, which are like what, 13, 15%, somewhere 12 to 15%. So 10 was pretty good, but I wanted them to know that. We looked at the common area, what that was going to impact. And we also made and addressed the amendment, which is clearly, the lease document, and the amendments are important to take a look at. Summarize the term, gross plus electric, and the tenant had to pay janitorial. We got the rental rates. Let's go down with this slide a little bit right now. Electricity. And then operating expense is usually a big thing to study, to take a look at. So first, I just summarized the fact that they had a lease ending in 2008. We added up their taxes and operational expenses, 723. And again, they were in a mid-rise building, Western area. This comes out of the lease, tenant to pay its proportionate share of real property tax and assessments, and its proportionate share in equitable cost and maintenance fees in excess of a 209 base year. So now there's your base. It says base, doesn't say year, but it's a base year. It's for operational cost. So this tenant had to pay over that. Here were my comments on the lease. So I said, well, there's no cap on the operation. What is a cap? There's no limit. There's no ceiling. Normally, we would say that, okay, you want to pass through, capital cost. First, we try to have no capital cost. And we fight hard on that. And if there are capital costs, we put a ceiling on it. But there might be other items in that expended for expenses that you want to put some control on at that point. Management fee. And I mentioned, they didn't put in that, I said all capital expenditures are allowed to be capitalized over the useful life of the expenditure. Okay. So they didn't do that. Okay. If we can go down a little bit. Okay. Now, that was a little more than I said. Okay, can you go back up? I'm sorry. Okay, let me just finish. Okay, comments. So no exclusions on capital costs. You always got to ask for that at this point. Where that will end up is that we will agree to, if it's municipally mandated, that doesn't happen usually. If they're changing the handicap law that comes up, that's municipal. Or if it has to deal with, I'm getting a mental blank at the moment. It'll come back to me in a minute. They'll come back and say, okay, if they put a new air conditioning system, that's capital. But then the landlord's going to say, but that's going to reduce your cost. If we put all these new LED lights in, that's going to reduce your electricity. So that's okay. All right. I'm going to move a little fast at this point. We can go to the next page on this. Okay. Lease audit. Okay. We're going to talk about lease audits, and I hope we have time. It's an important area. So this lease said tenant has the right to audit operating expense within 6 months of receipt of such statement, which is good. They've got 6 months to do it. I recommend auditing because there's always unintentional errors made and sometimes intentional things for operating cost. Right of first refusal, important thing to do so that any space that opens up, they had first right to do it. That was fine. Then we talked about the right to additional space. At this point, where it would be, the landlord already had laid it out, saying it would be as is. So at this point, as is means when they expand, the tenant is not going to get any tenant improvements. So I wouldn't accept that. Landlord always has to contribute. Option to extend, right of first refusal, that's important. They didn't put an option to terminate in. I made a note, none. Well, you can get that today. It's insurance, but you don't make any insurance payments. The best option to terminate would be that's a 10-year lease, and we're going to get a right to cancel anytime after the 5th year. And landlords will say, okay, but pay me back my pro rata share of tenant improvements and the broker commission. If you're going to leave early, I'm going to lose you early, then I shouldn't have paid you, the broker, because you're not staying. So a smart landlord will say, yes, we'll do that, but hold us over. Now, we've got holding over. Holding over means that they're going to move, but the space isn't ready to go to. They got to stay. Okay. So let me just read it here. Tenants should pay 120%, the highest rental anytime, means the highest rental in the area. And that was what, for the first 60 days, thereafter 150%. Kind of normal, okay? You can probably change that to a certain extent. In fact, 120 is good, usually 120, 125%. Be careful that many leases will say 7% a day. If you want to hold over, it's just 7% a day. So what's 7 times 30 is 210. So that's huge. But there's some well-known landlords that always will put 7% in. Assignment and subletting, that's important. Although, look what happened. Today we have hundreds of thousands. We have 300, I just went through this. We have 370,000 square feet, 370,000 sublet space on the market in Southfield, an equal amount in Troy, et cetera, et cetera. There's just no market for it at this point, but it's important to do. Okay, no security deposit, that's smart. Okay, let's keep going. Do I have any more on this one? If not, we'll go to the next item. All right, this one's going to be fun. I gave this lecture to the real estate club at U of M a few months ago. Let's go to the first page. Okay, I wanted to go over categories of buildings. Okay, core. Okay, so we're going to look at opportunistic, core, and value added. This is 101 North Main. It's fully leased. It's for sale again. Ann Arbor's wonderful. Every owner has made a boatload of money upon sale. Look at the tenants: University of Michigan, the largest law firm in the state. Varnum, another one of the largest banks in the state. A few other tenants. It's always full. So when we're talking about investing, you're going to overpay for this probably, but you're gambling that it's Ann Arbor. It's a tight market, a lot of need. Look at the kind of tenants that are in the downtown area. Rents for this building are now pushing like $35 a foot. I renewed Miller Canfield 15 years ago in the low 20s. So we call this core real estate. You're buying something existing. You don't have anything to do. It's not distressed. You're paying over for it. You're paying high, hoping you're going to get it in the future at that point. Next slide. Core plus. Okay. All right. Well, this particular one is the Arboretum, and this one was bought. This was, okay, I'm going to correct myself. Okay. This is not Core Plus. Apologize, everybody. Okay. Please make a note. This would be value add. Sorry about that. This Arboretum, built in the late 80s, at a cost of about $150 a foot then. That was bought by Friedman and Kajoyan. It's some number plus or minus $10, $15 a foot. Excuse me, I said $10, $15 a foot. Until 2012, down market, distressed property. This has been improved by doing a value add, by fixing up the common areas. Prior to the pandemic, a lot of leasing took place. Fairly good. You got a few miles in between. You get going east to Orchard Lake exit or going west to the I-275, and it's filled up quite nice. And rates, I leased space here in the late 80s, and the rent was $18.50. 30 some years later, the rent is $18.50. Okay, that's core plus. I'm sorry, value added. I'm rushing. Sorry about that. Next slide. There's your value add. Okay, so what we're kind of saying is this is kind of more, okay, this is the Buell building. Okay, so in this case, it's purchased several years ago by Bedrock, quality downtown building built in the 20s. Good look at good profile of tenants, parking garage, paid a good price for it. They renovated the lobby. They've been changing the terracotta on the outside. When I was trying to sell this, I didn't listen to the broker, but when I talked to the folks selling it, they said that this freight elevator, that they had to put a new one in. They said it was going to cost $1 million. I have no idea why that was what was told. So anyhow, Bedrock is doing well. They've raised rents. They've improved it. Value add. Good building, mostly occupied. It's not AAA like the Ann Arbor, but they're putting enough money in. They'll add more value to it and increasing the rents right now. The rents now, they were in the high teens and they're now in the mid 20s. Next slide. Opportunistic. Now I've got it right. Okay, opportunistic. So basically taking something, here's the Briarwood. Briarwood's doing horrible at this point, but it was sold. And the buyer is going to, and I took they're going to build this office building on the parking lot. There's too much parking. And that part of town, which is on State Street and 94, is pretty strong. Burlington area, 777 Eisenhower. There's a market there. There's a need. There's a shortage of space. So it was an opportunistic. They're adding value to their investment by turning that vacant parking lot, and they can build an office building. And they're doing a plum, and they're doing an outdoor strip center. So opportunistic. We found, I didn't even see that. Nobody saw that. That was just a dream, and someone thought there might be an opportunity. And I hear this is all pre-leased already. Next slide. Okay. Now, I got a slide on the screen that's blocking the first part out. Valuation of okay. Valuation approach. You've got the income approach that we've all learned, basic appraising based on the income with what's it going to cost and replace. Okay, first one I couldn't see, it's replacement. So we're going to take a look and say, what's the replacement at this point? Okay, and we're comparing it to other properties. What's the cost and the income? And you can use any one of those three, or you can blend them. The income approach is the most important because you're taking real income that's there today. You're going to come up with an appropriate cap rate and create value. The cost approach is the highest because it's brand new. So a lot of appraisers don't even use that at this point because it just throws off the analysis. Next slide. Performa. Okay. Just going to throw a quick performa. Can you get, Nancy, something off the screen that's blocking some of the screen that I can't read? Is that possible?
You be able to move that screen.
Oh, okay. Hold on. That's good news. Okay. Bingo. Okay. Can see it now. What is a performa? We just wanted to give you a basic performa for those of you looking to invest at this point. And we go over this with the students at that point. We talk about potential income. That's 100% occupied. If we can solve if we can fill up the whole thing. Got to subtract vacancy. Always subtract vacancy. Credit loss means they may not be paying the rent. Even if the building's 100% leased, you should still put a vacancy on. Why? Because somebody may not be paying the rent, going out of business. And then what's other income? When I ask people in my class, other income, well, if it's a apartment, you've got income from washing machines and dryers, internet, covered parking, or in a shopping center, it's percentage rent. So effective gross income is less vacancy and other income. Those are key terms. and then you get your net operating income. That is the whole heart of analyzing a basic analysis of a building. You have to have the NOI. If we have time, we'll quickly talk a little bit on cap rate. And cap rate is pretty simple. You're taking a number today that, what are people buying at today? What kind of cap rate? The higher quality, if it's a 101 North Main, you're going to have a low cap rate. The lower the rate, the higher the value. The more risk, the more money you have to put in, the lower, the higher the rate. So how is it calculated? So we're estimating the gross potential number and escalations, vacancy in, and then we've got to subtract all future revenue and expenses, subtract the projected future expenses from the gross income, getting our NOI. So sellers used to determine a property's cap rate to take the asset to market. So a seller wants this to look as strong as possible by using a lower cap rate, and buyers are looking to get a higher number. Is there anything at the bottom, or is it the next slide coming in? Okay, all right, there we go. All right, so we're just giving you some information on terms that I've talked about, and I'm trying to keep it going here a little bit. Vacancy, credit loss. Okay, NOI is again the heart of a basic valuation, and most people cap rate it. One comment I will make that's important is you can't go anybody's office. You hear cap rate every day. That's all we hear is cap rate. What's the cap rate? What did it sell at? But what's wrong with the cap rate? It's for 1 year. You're looking at 1 year. You're not looking at leases expiring in the next few years. You're not looking at what it might sell in 10 years. You're not looking at financing. You're looking at 1 year. That's okay. But if you're going to analyze, you want to do a discounted cash flow, projecting rent and losses of leases that may not get renewed. There's always leases not getting renewed. And the cap rate that you're buying at, many people will basically say, we're going to project that in 10 years, we're buying at a 5% cap in 2001. And in 10 years, we'll sell it at 5%. But you can't do that. That's not taking into account that you might lose tenants. So, excuse me. So that is important. Because what people do is a lot of the value, and this is the airmate, a lot of the value is based on the fact that what you're going to sell it at. It's based on 3 items: down payment, projected cash flow over 10 years, and hypothetical, what are you going to sell it for in 10 years? So you can make it look a lot more, profitable if you have a low cap rate in that 10th year. Be thoughtful about it. Next slide. Effective gross income. Okay, I explained that. Operating cost. I think we've gone over that. We can read that. Taxes, insurance, maintenance. So there's our cap rate. Okay. Well, let's go to that slide again. Pause for a minute. Okay, next, you had the right slide, Nancy. Okay, capitalization rate. Okay, it's a yearly return on the NOI. As I said, 1 year. So we got 10,000 coming in net, and we're paying 100,000. It's a 10% cap rate. That's math, but again, it's 1 year. Next slide. Okay. Is that it? Okay, that's it for this particular slides that I did. Is there, I have something new coming up?
No.
No? Okay. All right. I want to talk a little bit. And how am I doing on time?
You're good. You have about 10 minutes left.
Okay. All right. Well, I'm going to talk a little bit about office lease modifications. So many brokers have been doing this over the last year with the fact that tenants are saying we don't need all this space. We signed up for this kind of lease. We're paying more rent than we need. We need to get rid of space. So that's becoming a common area. As office tenants continue to deal with the uncertainty of the pandemic, one result is a mass underutilization of leased office space. Typically, the third largest expense for a corporation after payroll and healthcare. It's your office lease. So many tenants are either struggling to meet obligations of their lease, no longer require the size of the space in their current space. It's important to understand the options available to you to potentially modify the term of the lease. So the offer market, as I've mentioned, is flooded with sublease space. And it's removing it as an effective option for tenants. But with minimal new leasing, landlords may be more motivated to work with tenants to modify the lease. So a couple comments. So you got the landlord consideration. The landlord's got loan covenants and provisions with their lender that could potentially not allow lease modifications or require prior approval. That happens a lot. I worked on a nonprofit in Detroit in the Bedrock building, took 2 floors of 1001, and they just said, we can't pay for both floors. We want one. And they just said, it's not so easy. We got to talk to the lender. Took a while, but we did get it approved. The tenant's offer to the landlord should strive to create the least long-term financial impact on the landlord while accomplishing the tenant's goals. So you can have that idea. There's the phrase that we've all heard, perhaps those that haven't, called blend and extend. The tenant can request to extend the term of the lease in exchange for a reduction of the rental rate. This option provides the tenant with long-term cost savings with ensuring long tenancy and cash flows in the building. So we're obligated for X years at the rent we agreed to. We'll take on some more space at a lower rate. We can blend this and give us a few more years, and that's happening. Or a tenant can request to defer a portion of all their rent to an agreed upon date and amortize the unpaid rent over the remainder of the lease term. So that helps the tenant, gives the tenant a break, but they're going to have a bigger cost down the road. So that option to contract that I talked about, that's going to be important. What I wanted to do in the last portion is talk a little bit about lease auditing. Lease auditing is so important and saves so much money for clients, but it's not, you don't hear about it often. But in a good lease, you'll see a clause at the back for a lease audit, and it's already in there. And big landlords are already protecting themselves that if you want to come in with your lease auditor, we'll only allow you to go back 3 years. And if your lease auditor got you to get hired by saying that they won't charge a fee, they'll just go for a percentage of savings. Landlords fight hard. They don't want to do that, because they want to make it difficult on you. If your client is having to pay a lease auditor, the client may say, it's not worth it. And most lease auditors find things. My lease auditor finds money almost all the time. And a lot of landlords says, well, we don't want them coming in with that. So I would say I would not agree to that in a lease, especially now in a tenant's market. You want to be able to lease audit. A couple comments. So a tenant lease audit, seeks to identify areas where operating expenses, real estate taxes, and pass-throughs and charges derived from the landlord's book and records are in non-compliance with the tenant's document and provisions. We talk about doing operating clause issues and limiting cost. And so without the appropriate due diligence, verification, or inspection of the landlord's books and records, there can be as much as 50 cents to well over $10 a square foot that may be overcharged to the tenant. The underlying issues from simple human errors to intentional misstatements. So the lease audit accomplishes just this. It allows the tenant to have some measure of control over operating costs for which they're reimbursing the landlord every year. And operating costs in many office buildings can run $8 to as high as $20. Operating expenses and taxes can represent 1/3 of the total rent payments. I was representing University of Michigan a number of years back, and we started to do some lease auditing. And a landlord had a building on State Street, and in the lease, they leased the whole building to U of M. But there was a number in there that said when they were doing a whole back entrance to those are whole renovation, the front entrance back, and they basically said that there will be a rent escalation when the back entrance is completed, the whole renovation in the back, to that effect. So we found that they raised the rent, like in the second, third year, based on the lease. There was a clause the rent would go up, but they never did the renovation. And there was $200,000. And I'll even give the reference to Ed Weberman was my lease auditor. It was $200,000. And the landlord says, "You think I'm going to give you a check for $200,000?" Eventually, he gave them a check for $200,000. Another well-known landlord who was hired by a law firm in Bloomfield Hills, same lease auditor, Weberman. And we noticed that the lease said no capital improvements. Okay. And that landlord made a lot of capital improvements to the garage. And tenants had to pay it. It was included in expenses. It wasn't supposed to be. We took it out. We got a check back, a big check back. So it's really important. And there are three issues. There's landlords that make a mistake. Okay. Find my notes for a minute. Unintentional. They may just make an unintentional mistake, or intentional at that point. Or the building may have gotten sold and the buyer takes over and pass through the expenses every year. And they didn't go through every lease to see about exclusions in there. So, we find a lot of money for our tenants. So total rental costs generally represent the second expense, we said, in virtually all industries after cost of goods produced and payroll costs. By lease auditing expenses and taxes, the tenant might be able to potentially reduce the amount by 10 to 25% with the resulting rent credits. Not all landlords are created equal. Okay, at this point. When lease auditing the landlord, it's important to develop a sixth sense about the nature of the landlord and the operations. If the property manager is slow to respond, they're not doing good maintenance, they might be having sloppy books. Of all the operating expenses incurred by the landlord, what does the landlord actually control vis-a-vis the tenant? He controls everything at this point. A few more comments on that. So yeah, there's human errors, there's miscoding done. An error is an error. For example, maybe the property manager accountant miscoded a building's invoice to another project, thereby understating operating expenses and undercharging the tenant. It is therefore very important for a tenant lease auditor to fully understand the total impact of the error. Again, we call it a human error. And then there are intentional errors at that point that landlords will do at this point. A note that I have. So, a landlord invests in a new compressor for his rooftop HVAC system that costs $15,000. He might choose to charge this to the maintenance and repair expense. You may actually consider this to be a large replacement cost that extends the useful life of the cooling system that should otherwise be classified as a landlord capital cost. So again, lease auditing is something that should be done. All accounting firms do it. There's some small groups around. When I walk in, I basically tell a tenant they're going to charge you $3.50 an hour, or they'll charge you nothing, and they'll take 30% of what we find. And most people say, "We'll take the 30%. Go ahead, go for it." At that point, where am I in time at this point, Nancy? Okay.
We're about at our 50 minutes, Steve.
Okay, all right. Well, it's been a pleasure to cover. I felt like I was going pretty quick. Hopefully we covered a lot of good material. If anybody has my contact information is here. I'd be happy to provide anyone with any responses, or thoughts, questions. Thanks.